Hello. In this video, I wanted to provide you guys with an example of what I would hope you would do in a preliminary investor pitch for your forecasting a business opportunity project. Again, everybody's is going to be a little bit different, but I would hope that you at least hit high points like the ones that I'm going to cover. And I will also say that I do have a copy of my workbook where I've created the charts and so forth for this that I will make available, so that hopefully that's useful for you. Again, this is a preliminary investor pitch. The reason that it's preliminary is that really all we're talking to the investor about at this point is the cash flow forecast that we have. We aren't prepared to talk about risk assumptions or cost of capital or return or any of that sort of stuff right now. So we're going to start just with the cash flows, and that way you can get feedback from the investor on your assumptions and so forth, and work through those before we really start working on metrics. So overview, I want to talk to you about the business concept that I have. I'll talk to you about the income statement projections that we've made and the assumptions and forecasts for that. And then I'll talk about the balance sheet projections and the assumptions we made and some of the key sort of elements of that and forecasts. And then I'm also going to provide you a return on equity and DuPont ratio projection. Keeping in mind, we'll explain that at the time, that because we're not making any assumptions of cash distributions or reinvestments at this time. That's not necessarily a good indication of the value of the project. And then we're following that up with some investor projections in terms of free cash flow to equity and investment operating cash flow, terminal value. We actually don't have a terminal value, but we'll talk about that. So that's kind of what we're going to cover. Let's jump in with a business concept. Start with the need first. Any good business, you've identified an unmet need first, and you want to talk about that. Again, for me, the unmet need is that the Concord University Athens campus has very limited to no alternatives for dining, entertainment, and socializing that are primarily student, faculty, staff oriented. And you would see this reflected in the atmosphere of the establishment, the menu, the entertainment, pricing, hours of operation that made sense with campus life and so forth. Service to the campus, by that I mean delivery, I guess, to the campus, and other things as they might make sense. That is also off campus, so that the operations decisions are driven by customer preferences for student, faculty, and staff, rather than policies of the university or the state or the agreements with Airmark or whoever else. And we want it to be within easy walking distance of campus. The idea here is that many college campuses identify with a sort of a hangout, if you will. That's the place that everybody or lots of people go to socialize outside of class, and that hangout just becomes part of the culture of the school, and alumni talk about it and so forth. And so we would like to see this campus have that. The solution for that need, in my view, is a restaurant. We're calling it the Lion's Den. It's a full-service restaurant, possibly a bar, adjacent to the Concord University Athens campus. Have not nailed down the specific location yet, but we have a few ideas in mind. The atmosphere and promotions would be directed primarily towards the students. We're not trying to not attract the faculty and staff. But it's going to have more of a student vibe to it. You can't have both. Should have strong Wi-Fi, plenty of room to hang out, study, or whatever. So one of these things that makes it student-oriented, as opposed to some restaurants, is we're not going to try and rush you in and rush you out. We're trying to create places where you can hang out for as long as you want or need. Hours of operation would reflect the customer preferences for both commuters and resident students. And so we anticipate actually opening breakfast, lunch, and dinner And that way, if you're a commuter that gets here a little bit early and wants to go do something or meet or do whatever else, you can. And at least in the latter part of the week, we would anticipate staying open late as entertainment for students that have sort of wrapped up classes on kind of Wednesday, Thursday, maybe Thursday, Friday, Saturday. We do intend to be open. The model does not reflect that in the initially, but we do intend to be open at some point, at least on Saturdays throughout the day, maybe on Sundays. We want to try and do something that accommodates the fact that there is a significant resident body on campus and that their choices are very, very limited over the weekend. We want menu and pricing that reflects student preferences, provides for on-campus delivery, and we would like to see it have a game room and regular live entertainment. So things for you to do other than just sit and eat and be on Wi-Fi if you want to. Anyway, that's kind of the thought. The primary customer base is comprised of student, faculty, and staff. We do assume some secondary customers from Athens and maybe the surrounding area. We assume a fairly low amount of that. We may find that that's not that in fact we get more than that at some point. Talk about the income statement first. Key assumptions. Again, the primary customer base is comprised of students, faculty, and staff. Secondary from Athens. We assume a smooth growth over the first year in the number of customers, pretty much starting out with none and growing up to an amount by the end of year one. And so then that customer count sort of plateaus in year two, and we keep the customer count the same for the remaining 10 years. We don't adjust. We didn't in this model adjust for the times when the campus is closed in the annual stuff. But we're thinking that since we've not accounted for any growth in customers during the time when it's in session, we've not accounted for the regular clientele, we've not accounted for the fact that we would be actually open more days of the week starting in year two. That we think that all of those together on an annual basis would more than offset the revenue from those months. However, we may want to go and model that at some future date. Just have not done that right now. In terms of revenues, we assume 1,000 students on campus per day. Concord actually enrolls more than twice that, but not all of them are on campus every day. So we think that's a conservative assumption based on counts and classes and so forth. We assume up to 20% of students as customers per day, and that's kind of at our peak. If we thought about that rather than being that they all come in at once, which would be 200 students all at once, we're really talking about spreading it out over 3 meals a day. And so you're not talking about 200, you're talking about maybe 60 students, let's just say, for breakfast, 60 lunch, 60 dinner, or, obviously that could be distributed differently throughout the day. So at peak, I think that's reasonable. If we can't achieve that, if we can't achieve, if you think about an average table size of being sort of 3 people, if we can't achieve an average table size of, or an average number of tables, let's say 20 tables, at each meal, then we've really missed the mark on this, and we probably do not have the right business concept. We assume 30% faculty and staff on campus per day since they're here most of the time. That may be a little bit high now, but we'll have to go back and look at that. We assume 25% of the faculty and staff per day as customers, for a variety of reasons. One, they don't like eating in the caf as much. Two, they actually have money to afford to eat away. So don't think that's entirely unreasonable. And of course, at 25%, that would wind up being about 75 customers per day. Again, not all at one meal. Some breakfast, some lunch, some dinner. You get the idea. And then up to 40 customers from the surrounding area per day when we peak out. And again, split between the meals, that's not actually that many. Average per person revenue, we're going to assume that starts out at $10, and then we inflate it 2% a year starting in year 2. Expenses, we got variable costs, food and labor costs, 25% each. The 25% labor cost does include management salaries. The 25% food cost is based on the idea that we would be giving them good value, so they would get a fair serving and amount of food for the $10 or whatever they spend. Period costs are 10% of revenue. This is a lower number because it's not going to have to include rent. It's really just utilities and sort of those sorts of things, because we're actually buying or building the facility. In terms of expenses, we will have depreciation of the long-term assets. Straight line over 10 years is what we've done. We can modify that if you like. Again, since that's non-cash, it does affect taxes, but otherwise, this is probably a conservative assumption. And interest expenses, we are going to take out debt. We're going to do 80% debt financing of the building equipment, and so we'll have an 8% interest rate on that. And so that'll be in the interest expenses as well. So if we look at the income statement for year 1, the way to look at this is what's called a stacked graph. And so the total of all of these bars is your revenue. And now you can see where that revenue went to. And so, if you start, usually we start from the bottom. Period costs will eat up a certain amount. You can't really see that here, but period costs start to eat up a certain amount starting in month 3. Kind of the first couple of months, we basically are assuming we're trying to get open. The variable costs, which are the food and labor costs, remember those are 50% of everything, so they're going to grow as the revenue grows. Interest, you can see interest is not even in the monthlies, because we're assuming a 1-year payment of interest at the very end for this. Sort of a typical commercial loan structure. You don't make payments monthly. You make them once or twice a year, and we're assuming once a year payments. Taxes, you'll see that we just assume 25%. Down here, actually getting a tax credit because your net income goes negative. It goes negative because you're making that big interest payment that's going to eat into everything. So that plus your depreciation gets charged once a year. So think of it as though you got this revenue, you've just taken out this much additional charges that you didn't have in other months, and so it's caused you to go negative by that amount. And you do have this tax credit. By the time you get to years 2 through 10, you're now talking it instead of monthlies, annuals. And so what you're really just seeing is sort of the steady growth in the revenues. So that's the total bar. And of course, by year 10, I guess in year 7, we're looking at about $780,000 a year in revenue. By year 10, we're up to about $800,000 a year in revenue. And the net income on that, you can see, is still pretty good. It's this wedge right here, and so that was 900,000, wasn't it? Yeah, so somewhere between about 750 and 9, 650 and 9. So you're looking at about 250,000 in net income a year by the time you get out to that distance. And not surprisingly, since variable costs are really done on a percentage basis, they're sort of what's eating up most of that. You see the taxes, obviously those are on a percentage basis. Depreciation is constant throughout, and actually year 10 is the last year we have depreciation, so it goes away after that. Same thing, year 10 we would have completed paying off the loan. It's hard to see here because it's such a small component of everything, the interest expense. But it's getting smaller over time, and in fact, year 10 is the last payment. We have no interest expense after that. So let's talk about the balance sheet. We assume that we're going to need long-term assets of about $308,000. We estimated that as 40% of the sort of peak sales as they happen in year two. That's consistent with sort of asset turnover ratios for similar types of restaurants with similar types of investment needs, in particular buying and building their own facility as opposed to renting. Most of this is land and building. We assume some for equipment. We assume we're going to finance that with 80% secured debt at 8% interest and amortized over 10 years. So not like a bond that a corporation would issue, but more like commercial debt, where we're going to make one payment per year, every year, and that's going to be a combined interest and principal payment. That annual debt service is about $36,721. If you go back and think about that from the perspective of the income statement, the annual incomes we have estimated at somewhere between $650,000 and $900,000. So this is really a small part of all of that. And we're going to depreciate the long-term assets again using a 10-year straight line depreciation schedule. That's for simplicity. Quite frankly, that may be a little bit higher depreciation than we'll actually have for a couple of reasons. One, the land you usually don't depreciate, you split that out. Two, this is a 10-year straight line. The building and the equipment probably are going to go to a useful life that's more like 15 or 30 years. Now, they may not be straight line, but nonetheless, that's going to change the depreciation as we dig through this. But for now, just sort of an indicative calculation, there you go. Working capital on the balance sheet, we're looking for initial cash for operations of $62,200. That's equivalent to the monthly revenues once we sort of reach our peak. You'll see when we do our analysis that quite frankly, that number may be a little bit high, but we have not actually built in any of the sort of month 1 and 2 startup costs yet, and so we're going to hang on to that for now. This cash portion is going to be financed 50% of it with unsecured debt. It's a 1-year note, and so we're going to pay an 8% interest on that. Again, the interest rate's similar to that secured note, but since it's only 1 year, this is pretty realistic for what we might be able to get that, assuming good credit quality on that. So that means that we only have to come up with $31,100 in our own cash because the rest of it's going to be covered by that note. We don't assume any accounts receivable. All our customers are going to pay cash. They may pay with credit card, but we're really talking about just the timing of the transaction payments. So we've not built anything in for that. We assume an inventory of about 2 weeks worth of food costs. Can't really go much more than that because then things start to spoil, and that's the primary element of inventory. And we don't assume any accounts payable right now. We assume that we pay all vendors in cash. We may have the option of doing something different, but at this point we're just going to make that simplifying assumption. Then in terms of equity, again, if we think in terms of that 80% of the fixed assets are financed by debt, the other 20% must come from equity. And so that's $61,600. And then 50% of the cash for operations was financed, so the other 50% has to come from equity. So that's $31,100. So we would need a total equity investment of $92,700 initially. When you look at the balance sheet, kind of looking at the current assets again, since there's the current liability, I'll just roll in with the other liabilities. There's no accounts receivable, so it's really mostly just cash growing in the cash account in year one. The inventory is getting larger as the food costs get larger because our sales are getting larger, but they're going to sort of cap out, and they're really insignificant compared to the cash. We get this big drop in month 12 because in month 12 we're going to pay off the current debt that we use to finance half of our cash needs, and we're going to have to make that first debt service payment. And so between all of those, you can see that we had sort of built up to somewhere around 140,000. We're going to fall back to somewhere around 100,000. Now, the reason that it's not the full amount is that we are making some cash in that month as well, right? We're going to wind up with, some amount of additional cash that we earn in that month, maybe an extra $20,000. And so that's going to help pay part of it off as well. If we look at the long-term sort of situation on current assets, again, inventory is really insignificant. It's cash that's growing, and in fact, by 10 years out, we have over $2 million worth of cash in the account. Now, that's so that you understand what this would look like if we didn't reinvest by opening a new business or distribute the cash back out to the owners or whatever else. So obviously, this looks like this business is just building up this huge cash reserve. From an equity standpoint, we can make different decisions about distributing that, but right now, since we haven't really talked about that, we're just going to assume those cash flows. In terms of liabilities, in year one, of course, the big one is the long-term debt. We also have a little bit out here in the current debt financing the working capital. By month 12, we've both paid off all of that current debt and paid down the long-term debt, the first chunk of it. Going out, we have no more current debt, and all we have is long-term debt, and we pay that off at the end of year 10. And so you can sort of see that our debt's going down rather quickly. Well, if our assets are growing and our debt is going down rather quickly, then you can imagine what's happening to our book value of equity. Again, we start out with capital contributions of the $92,000. And we don't really ask for any more capital contributions because we don't need it based on these projections. We start adding retained earnings very quickly. Those will really start showing up in months 4, 5, 6, 7. And by month 12, you now have a capital count, book value of equity that's approaching $180,000. So it's nearly doubled from what it was at the beginning of the year. And then, of course, years going forward, again, no need for capital contribution, and we're starting to put substantial amounts into retained earnings. And so, sure enough, we're now looking at having retained earnings in excess of $1.8 million, capital book value of equity of $1.8 million by the end of 10 years. So, again, a substantial growth. Let you see kind of what the investor cash flows, right? Free cash flow to equity and capital budgeting cash flows look like. Free cash flow to equity, small number. This is the one in blue. You can barely see it. It's sort of swamped by this big capital budgeting investment number. Free cash flows to equity are negative initially. That just reflects the amount of free cash flow that we needed to go out and get and then spend something on it, and so it's basically the amount that we had to spend on the debt, or on the assets. Sorry, and you see over time in those first months that everything sort of grows the same. Capital budgeting and free cash flows are very similar. They go different directions in month 12, obviously, because the capital budgeting cash flows don't reflect interest payments. Right, whereas the free cash flows do, and so those free cash flows are going to go negative because we have the big payment. If we take that forward, sort of the same thing is going to continue on. The free cash flows they do include the fact that we're making principal and interest payments on the debt, and so they're going to kind of consistently stay below the level of the capital budgeting cash flows, but they're slowly catching up, and the main reason that they're catching up is that we're basically eliminating that debt, and so at that point they would be fairly similar. I don't have a terminal value on this chart. However, if you did nothing more than basically look at let's just use the final capital budgeting cash flow, looks like it's somewhere around $275,000. The terminal value is simply that divided by whatever you think the right discount rate is. So, for example, If you think the right discount rate is 10%, then you take 275 divided by 10%. That's the same as multiplying by 10. It's $2.75 million. And as you know, that terminal value reflects the value of all the cash flows going forward into the future. Now, our cash flows grow at 2% a year because of inflation, so you could technically use a 12% rate. Again, we'll cover a lot of this later with you, but we would estimate probably a 12% rate and still get you at about the 275 or 2.75 million. So really, the way to think of that terminal value is if I got to the end of year 10 and the business is going good and I tried to find an investor for it at that point, assuming that they were happy with about a 12% return on their investment, they should be willing to pay me about $2.75 million at the end of year 10 to take over the business from me. So that's a cash out. So I get to keep everything that I have up until then. I can distribute that, and then I get the cash out. I did do a few more metrics just to kind of let you see what happens on this return on equity and the DuPont measures. I only did them for year 2 through 10. They really don't make a lot of sense to start doing that in the first monthly sort of periods because you'd be looking at a monthly return and trying to compare it to an annual return just doesn't make a whole lot of sense. But you'll see return on equity starts out pretty good. It's in the 50% range. That's phenomenal for a return on equity, but drifts down to right around 10% by the end of the year. And if we want to know why that's happening, we can break it down. The profit margins staying about the same. So it's not because of the operations per se. Our assets are shrinking, right? And so the asset turnover, our assets are growing, and so our asset turnover is going down. Our assets are growing because they include that big cash amount. So think of it this way, that at this point, the asset turnover, remember that is sales divided by assets, right? We're at 140% because you're basically saying, look, we're selling a lot and we really only have that 300,000, or $350,000, $75,000 worth of assets. Well, this is going down because your assets are growing. Your sales are growing, but your assets are growing a lot faster. This would reverse itself if we either took the money and say invested it in other businesses, the cash, so that we had the sales from those to include in this. Maybe we open up another one of these in another area. Or we distributed that cash back out to you guys as distributions, dividends. If we did that, then you could sort of achieve a level of asset turnover that would be fairly consistent. The other thing that's going on that is our leverage is actually decreasing. Our leverage is decreasing, if you'll remember, because the leverage is assets over equity. And you'll see that by year 10, it's to a 1. It's a 100%, meaning we're 100% equity financed. It's because we took out that big loan to buy the assets, and then we paid it all off, right? And we've not taken out any more loan. Not saying that we should, but we might consider going ahead and maintaining some sort of a balance there. That would also help return on equity. We might just keep a current debt that we always have or something like that. I know it sounds counterintuitive. Oftentimes people think it's counterintuitive to borrow money that you don't need. But quite frankly, if you can borrow it and put it to good use, it does make sense. Now, that's really the question here is, do we have a good use for it? And think of that as maybe a phase 2. So that's kind of the lay of the land right now in terms of the project, and I'm open to questions. Okay, and so this would be the point that I, as the proxy investor, would jump in and start asking you questions. I'm going to try to not interrupt you as you go through your pitch, and I'll save my questions till the end. All right, hopefully that's helpful. Thanks, guys. Bye.